Welcome to today's episode of the Simply Financial podcast. I'm your host, Christopher Calandra, and I want to increase your financial IQ with today's episode, which is a bit of a follow-up. We're early in 2023. Recently did an economic outlook. There was part one and part two. This was presented to the Elliott Wealth management community by way of webinar, and we converted into a podcast too for broader distribution. So please check out parts one and two if you haven't listened to them. But quick summary, the country is dealing with intense inflation. You probably know this, don't need me to tell you about that. And because of this intense inflation, the Federal Reserve is fighting back by raising interest rates, and also, and this happens behind the scenes, is reducing their balance sheet, which is selling things that they hold like bonds and in some cases stocks. What the Fed is trying to do is to destroy demand, weaken demand. They want to increase unemployment. I know that sounds odd, but they want to reduce the amount of excess liquidity that's in the system that's contributing greatly to the inflation problem. So they want to slow economic activity. So that means there's an increased risk of a recession. And that's a consequence of the inflation fight. So I talked about the interest rates being increased. There was a lot of that in 2022. As you probably know, the Federal Reserve raised interest rates 7 times for a total of 4.25%. That's a lot in a short period of time, especially given that we were coming off essentially a 0% interest rate environment. So the Fed's goal, the Federal Reserve's goal, is to reduce inflation, getting it to the desired levels, which is around 2%. The thing about this is they want to go quickly and they want to do as little harm as possible. But that's a tricky proposition. The risk is that they go too slow and allow inflation to run. They did likely do that in the early days of the inflation story when they were slow to act. Part of the reason why they were so aggressive in 2022 is they were playing catch up. So they don't want to go too slow and allow inflation fester and to gain momentum. The other side of the spectrum is that they don't want to raise rates and reduce their balance sheet too much and too quickly because they don't want to do more harm than is necessary. They kind of want to hit the target. They don't want to come up short, and they don't want to overshoot the mark either. Again, it's a tricky proposition. Inflation in December did come down compared to November and previous months. It came in at 6.45% for December. That's a year over year number. That's a pretty good number compared to June when we were over 9, and a couple of months after that when it was 8 plus. It was in the 7 plus range in November. So the Fed is having the desired effect. So they can successfully, the Fed can navigate this. It's not easy though. And what we're talking about is something called a soft landing. So that is kind of what it sounds like. Can the Fed raise interest rates, fight inflation, do as little harm as possible such that we get a soft landing? Get inflation under control, land the economy softly, avoiding damaging the economy, not too much anyway. There'll probably be some damage. We already see that a bit anyway, but try not to do too much damage. That is a soft landing. I think in the public dialogue, in the papers, on the news, if you listen to talking heads like me, there'll be increasing talk about a soft landing. I think recently, as of this recording, the confidence of the Fed's ability to pull off a soft landing has increased. I think that has corresponded with some good news for the markets. I think they are related. So I think the markets can do well when there is confidence that a soft landing is coming. As I just said, We've seen a touch of that recently, I think. So for these reasons, I am dreaming of a soft landing, and I think you should too. Dream of a soft landing. Thanks for listening to today's episode of the Simply Financial Podcast. I'll be back with you on the next episode very soon. In the meanwhile, I mentioned at the top of the show, Elliott Wealth Management Services. Please check out our website, elliottwealth.com. You could get information about me, the team here at Elliott Wealth, how we help our clients win with money. You could sign up for a complimentary consultation if you want to talk about your goals and objectives and how you could best cope with this inflationary environment we're dealing with. Again, thanks for listening. I'll be back with you soon.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.